So, perfect. It seems like it's recording now. I hope everybody can hear me okay. To introduce myself again, my name is Matthew Kim. I am currently a social studies teacher at Sauk Prairie High School in Sauk City, Wisconsin. I've been teaching there for about 4 years, and as you can tell, yes, I'm an Asian too, but I'm Korean American. So I was born here, raised here till like I was a child. But then I went to Korea to stay for also about 10 years there. But then I came back to America for college and everything. Now, I I went to college in 2014 and majored in history and economics. I initially actually wanted to study just history, but then I found the beauty in kind of economics as I was in college, and and then it just attracted me to major in econ as well. So it is my honor to always get an opportunity through Shirley to be able to teach economics and business and everything. So every time I get a chance, I always think about what be a good lesson, what be a lasting lesson, with the lasting impact, with the long impact in you guys. So while I have this time, I would personally call this lesson I'm about to give as one of my best lessons that I give even in my school. So I hope you guys also like it too. And I think the topic alone should be very interesting by itself. So show me through your emoji. Who wants to who wants to get rich? A lot of people, right? Yeah. Some people say, being rich is a bad thing, but I think what I mean by being rich is not being like a bad rich person. But, but for you to have some sort of a savings, by the time you retire, for you to have enough money for you to get by every day while you can do whatever you want to do. And also at the same time, for you to have the discipline in giving up what you want to do so that you can save for a bigger future. All those things, right, are the cornerstones and stepping stones of becoming rich. Um, and with that in mind, I prepared this lesson today. And actually, I never tried it internationally before. So I hope we can actually try this together. There will be a video game that my class loves to play all the time. um, it is something to do with investment, and my students love it so much that even after we do this in class, they do it by themselves in their free time, and they enjoy it so much. So um, I've just gave you a lot of hints and a lot of excitement, and let's get into it. So give me just a second. So our lesson today is about. Oh, give me just a second. Our lesson today is about investment 101. And through this lesson, I'll try to answer three big questions. And again, I have access to the chat as well. So if you have any questions, just feel free to ask or ask to Shirley, and Shirley can just interrupt me, and I'll try my best to um, to answer as much as I can. Yeah. All right. So anyway, our lesson today is on investment 101, and I'll try to answer these three questions. One, how to better invest your money. And two, how to be a wise investor. And three, which investment option is right for you. So we'll cover all these questions. Okay. Now, when you think of investment, how many ways can you actually think of? Like you can just type like certain number on the chat. How many investment ways can you usually think of? Stocks, definitely. Yep. ETF, very good one. Yeah, ETF and mutual funds. Okay, I believe I've seen Mr. Anthony Chung and Miss Emily Wang before. I assume they are teachers. Fixed saving, futures, future. Okay, all right. Yeah. So I'm surprised that you guys also actually you guys actually have some of these ideas that I'm about to share with you guys too. And it is very important to know about all these so that you can be a right investor to really right investor for right future, right? So, one thing, does money grow by keeping in your piggy bank? Now, when we actually say those like a um, little like a money money box, but in the shape of pig, we call it piggy bank. Gina, that's right. No, it doesn't grow, right? No, it it doesn't necessarily depreciates unless there is a huge well, I get your point because it is always expected to have a constant inflation every year. So that means if your money stays in the piggy bank, then it depreciates. However, what what if you put more money into the piggy bank every time? That as a piggy bank, the money as a whole, it doesn't necessarily depreciate. But I get your point. It at least doesn't grow by itself, right? So we're going to take a look at about 7 different ways of investment. 2 of them are quite extraordinary ones. So we'll just focus on like 5 things mainly. First thing, of course, is savings account. And you guys will already know this. Second thing is certificate of deposit. Now, I I translated this using ChatGPT. So please let me know if the translation is wrong. But I try to find the as close translation as possible by referring to Korean and everything too. But second thing that was not in Taiwanese Chinese. Oh, all right, perfect, perfect. Thank you, Mr. Shi. So certificate of deposit is the second way, which I haven't seen in the answers before. Third way is index fund. Fourth is individual stocks. Five, government bonds. And six, crop commodity, quite surprisingly. And there's actually a good side of it too. And lastly, of course, Huangjin, right? Huangum, gold. So let's take a look at some of the perks and some of what they are, what each of them is, what are some advantages and disadvantages. Okay. So savings account. Savings account in real life, you get it through a bank. And savings account is a very classic way for you to save money, right? So instead of keeping your money in your pocket, put it in a savings account with a low interest rate, right? I'm my statistics here. Statistic here is based on American average. So in America, the interest rate in a typical savings account in a year is 0.43%. I'm sure a lot of you growing up heard that if you put your money in a bank, your money will grow. I used to think that way too. But when I actually look at savings account and its interest rate, I realize how small of a growth that is. And I realized that I wished I knew all the other investment opportunities that I actually investment opportunities when I was your age. Okay. So savings account, definitely the nice thing about it is you're not going to lose money easily, right? Like let's say you made I don't know, 10,000 new Taiwanese dollar. And you tried and you don't trust the bank and you just put it under your mattress. And one day, your brother or your sister found it and stole it. Then that money's gone, right? You may kill your brother, but that's a different matter. But that money, as far as it's concerned, is gone. But when you put it in a bank, unless the bank fails, which won't likely to happen, you're not going to lose money from the theft, right? And second thing is you can in the money in the savings account, you can liquidate it. So that means converting assets into cash very, very quickly. So this is a great way to build up emergency fund for surprise situations like medical bills or car repairs. So in America, financial advisors recommend you usually to have at least 3 months of 3 months worth of your expenditure into a savings account so that when something happens, you can use that money. Of course, there's a downside of it too. Um, let's see, fixed saving in different currencies. Uh, I'm not sure if that is for me to hear or for you to just say to the students, but I'll just move on. Yeah, please clarify me if there's something I need to explain. Okay. Downside is you're not gonna make a lot of money out of savings account, contrary to what we grew up with, right? The concept of putting your money in the bank and it will grow. But to be honest, it's not that much. Now, second way is certificate of deposit. Now, certificate of deposit is even what I use right now too, after learning about it. The picture on the right is literally the screenshot from my bank that I use in America called US Bank. So if you put money for 5 months, at least while in that 5 months, the annual interest rate will be 4%. Now, if you put money for about 1 year and a little 1 month over, you'll earn 3% interest rate for sure. So that is still 3% might not be a lot, but it's still better than 0.43%, right? So what is CD exactly? So this is something that you also get it through a bank. And when you buy a CD with a fixed interest rate that will hold your deposit for a fixed period of time. And generally, the longer the maturity period, the higher the interest rate is going to be. Oh, then Mr. Kim, why is this APY? Why is this one for 5 months much higher than the 13-month? Well, that's because you have to be careful. APY is annual interest rate. So in Korean we call it 연이자, 년이자, or something like that. But that is 4%. But since I'm actually saving only half half a year, right? Only 5 months. Well, actually a little less than 5 months. In fact, my actual interest rate that I'm gonna earn while I put my money, freeze my money for 5 months, is going to be about 1.8%. So 1.8% may not sound a lot, but still, again, it is better than 0.43%, right? I buy foreign currencies at a lower rate and save them in my fixed saving account. And when the fixed saving interest rate rises, the exchange rate rises. I'm very happy. Oh, yeah. So that is also another great way for you to invest. But I think invest like exchanging foreign currencies, unless you know very much of the knowledge about it, I I personally wouldn't recommend it. And also, it is very, very dangerous when something like you guys heard what's happening in Korea, right? As soon as something like in Korea with martial law took place, the whole exchange rate in Korea, the value of Korean won just went down so hard. So it depends on the political situation, social situation. But if you are actually already very aware of how it works, yes, foreign currency exchange is another great way to make money. But at least in our lesson today, because it's going to be a base investment 101, so basics, I'm not going to talk about that. So I'm going to talk about a little bit relatively more safe way of investing, more steady and more popular way. So anyway, so generally, again, certificate of deposit, longer the maturity period, the higher the interest rate is going to be. A nice thing about CD is interest rate on a CD is higher than that on a savings account, interest rate on a savings account. But there's also a downside to it. Your money gets locked up until the maturity date. So you cannot also take the interest until the maturity date comes. And if something happens and you need to withdraw, you need to take out that money in the certificate of deposit account, you'll have to pay penalty, and that will be and that will actually, and usually that penalty is going to be much higher than what you could have made by keeping that money until maturity date. So a great way to utilize CD is, if let's say you have, I can actually tell you my example. So I have I in my savings account, I have $6,000 in my savings account. And that's because in average, my monthly expenditure, monthly use of money is about $2,000 US dollar. So 3 months saving is 6,000, right? But I know for sure that one, I'm not going to get fired in the near future. And two, I don't expect to get sick either. And three, I don't think anything's going to happen where I'll have to spend more than $3,000, you know? So what I did is, out of those 6,000, I actually made a CD of 4,000, a CD with $4,000. So I still have $2,000 of monthly saving in my savings account so that I can liquidate it, convert it to the cash when needed. But for the $4,000 that I know for sure, I actually made it with I actually made it with I made a CD out of it. And in fact, this APY for 5 months, 4% is the CD that I actually purchased, that I bought. And I know that it's gonna grow, and it only takes 5 months for me to make about 1.8% interest. You know, that's roughly about, I would say, 70 bucks, which is not bad, right? Because I know I'm not going to use that money. So why not let the money work on its own by itself? Okay. Thank you so much for all the translation. And I know some of the terms may not be very familiar, and I try to come up with some translation, but sometimes, I take for things granted. All right, now here, here is the main thing: index fund. This is what I always tell my students to invest in, because time is money. Time is money. And if you invest in index fund, it's bound to grow in 10 or 15 years. So before I actually get into this, um, I'm gonna I'll have to make it very clear, because some people already know the concept of ETF, right? Um, I think I'll have to explain the difference really quick. So ETF is a is a is a mutual fund in a stock product, that can be bought, mutual fund that can be purchased like a stock. Now, and mutual fund alone is a investment item, um, that you buy from investment company. So this might be a little bit unnecessary. So if you don't understand, you don't need to worry about it for now. But there are two different ways for you to actually invest in index fund. One is through ETF. Another one is actually through but actually buying mutual fund. Now, there is some difference, and I can get into the detail, but I'm sure that a lot of you have even never heard of ETF to begin with. So I'm going to just when I say index fund, I'll mostly focus on my explanation on ETF because ETF, in my opinion, is much easier to buy and much easier to sell, much easier to understand. Okay. But if you have questions, please send me an email. I'll have my email address at the end. So if you have a question about the difference, send me an email and I will gladly tell you everything I know. Now, but back to the lesson. So index fund is basically instead of buying and selling individual stocks, you are buying a bundle of stocks. Okay. So this bundle of stock is what we call an ETF. So you're buying a bundle, a basket. So um, now to get before we get further into it, we have to understand then what does index mean. So index basically means measurement. All right. So index is a measurement. Then what do we measure? So here, let me actually share that over here. Index. So as a bundle, index fund is a good indicator of a wealth of economy. So index, we have this thing called economy index. So it's just a way to measure our economy. Then how do we measure our economy? That is through looking at the index. So we have popular indexes in America. First thing is S&P 500, or in Taiwan, it says 0050 or 0056. But in America, the biggest economic index is S&P 500. So which shows top 500 US companies' performance. And on the right, you can actually see the top 25 companies in S&P 500, right? So it's a bundle of Apple stock, Microsoft stock, Google stock, Amazon, Nvidia, all kind of put together, right? We also have NASDAQ, which is a index measurement of how well top 100 US companies are doing. And we also have Dow Jones, which is top 30 US, how top 30 US companies are performing. So by looking at this kind of index, we can see that if S&P 500 goes up, that means in average, about 500 companies are doing well. So our economy is doing well. But if S&P 500 goes down, that means in average, again, 500 companies are struggling. So therefore, we can say that we are struggling economically, right? Now, since a lot of people already know about about the ETF, I'm gonna focus my example with the ETF. So technically, because these are just a measurement, like you just measure economy, when I actually write down S&P 500, when I show you S&P 500 like this is actually not like a stock price, but this is more like how well American economy, at least top 500 companies are doing. So over the course of 6 months, right? Most companies were expanding, they're growing. In 1 year, right? Companies are again growing. So it's a good indicator of economy. So technically, it's just like how we cannot invest in centimeter or kilometer or meter, we can technically not invest in S&P 500 itself. However, some investment companies came up with this idea. Well, if we know what the 503 or 500 companies are in S&P 500 is, then can't we actually come up with our own bundle of stocks and actually sell it in the stock market? And that's where the idea of ETF came from. So I can actually show you one of the most popular, most popular ETF for S&P 500 is what we call VOO. This is S&P 500 ETF made by one of the biggest investment company called Vanguard. Okay, so you can invest in actually this ETF, the bundle of stocks. So this one you can actually invest this. So you can, as you can see, it follows almost the same trend as what the actual S&P 500 does, right? Now, then Mr. Kim, well, we have a Vanguard S&P 500 ETF. We also have, I actually heard of this thing, SPY. Now, this is also S&P 500 ETF. Now, what's the difference, Mr. Kim? Now, that's a very good question. That's a very, very good question. The difference between them is depending on which company actually made this ETF product. So for SPY, I believe it was made by is it? Let's take a look. If on the NYSE, let's see. I'm not actually quite sure which company actually is responsible for issuing SPY, but I know for sure that for VOO, it is by Vanguard. Then, Mr. Kim, then like which one should I invest in more? That's where you need to look at their what we call holdings. So I know this is a very, very like small number, so I'll try to I'll okay. So this one I think is for SPY. And what we can see is the percentage and the company list. Company list. So we can see this in SPY's S&P 500 ETF. We have Apple, Nvidia, Microsoft, Amazon, Meta is Facebook, Google, Tesla, Berkshire Hathaway, which is owned by Warren Buffett. And we can actually see the percentage, right? So 7%, 6.65%, 6.16%. So what does this mean? This literally means if you invest $100, just $100 into SPY ETF, that means $7 will be invested into the Apple. $6.65 will be invested into Nvidia. $6.16 will be invested into Microsoft. So that's how the pie, the weight, the percentage is shared. Then Mr. K, how about VOO? Very good question again. So if you look at it on the first spot, you may think they are almost the same. We have Apple again, Nvidia, Microsoft, Amazon, Facebook, Google, Berkshire Hathaway. Then what's the difference? Here, the percentage is the difference. So for Apple, for VOO is 7.12%, but for SPY, it was 7.06%. For Nvidia, it has 6.77 and 6.65 versus 6.65. So depending on what company that you look at, each company will have different strategies to distribute the pie, the 100% pie, because it is literally 500 companies. So you have to really decide, you have to proportion them based on your strategies, right? So VOO is Vanguard's strategy of how they proportion the percentage versus SPY. So you can, if you're somebody that really truly believes in Apple, right? Then you might want to actually invest more in VOO, because VOO is 7.12%, while SPY is about 7.06%. So that may not be a good, like big number, but think about how big it's going to be when you invest in thousands or 10,000s, right? Then that means either it's not just $7, it can be your $70, $700, right? So the bigger the number gets, the more it is important for you to look at the percentage, the distribution in each of the ETF. Okay. Um, so so index fund is a great way for you to actually grow your money in a very fast way. So I always do this. Um, what year are you guys mostly born? Except for teachers, for students, I want to know, like, what year are you guys born? Can I see on the comment section? 2007. Okay, so let's actually go with 2007. How about that? So if you're 2007, 2009, okay, great. Well, how about let's go with 2005? Okay, all right. So if you're 2007, then you and I have actually 12-year difference because I was born in 1995. So if you 21523, uh, easy to call, if you invest right now and 12 years later, you'll become my age, right? And think about and take a look at how much the money can grow. So S&P just by investing in index fund or ETF. So you said you were born in 2007. So let's just look at like 2007 is and let's just go with May because May is kind of you know what, June. Why not? So on June 8th, 2007, S&P 500 was $1,507. Okay. And right now, 12 years, 12, right now, well, actually, you know what? We shouldn't actually think of it that way, right? We have to go back 12 years because of our age gap. So that would be 2012. All right. Sorry about that. Um, yeah, let's go with the June. All right. In June 2012, S&P 500 was $1,342. Okay. Oh, by the way, Mr. Kim, then does that mean I have to invest 1,342 in order to actually invest in this? No, you can invest in fractions too. You can actually invest $1, you can invest in $100, $1,000, doesn't matter. But you're going to enjoy the same percentage growth. Does that make sense? So right now, it was $1,342 12 years ago. And let's and oh, 12 years ago it was 1,342 and right now it's $6,090. So that's what? Roughly what? Four times, am I right? Roughly four times. So that means if you put um maybe $4,000 like right now, then 12 years later, you're going to have 16,000. Think about that for a second, right? By doing nothing but just investing in the market, in the S&P 500 or index fund overall, you're not losing any money at all. You're making money because market is always growing, okay? So usually it is when it comes to S&P 500, my personal recommendation is to invest more in the American market just because American market has all the leading global companies are in American stock market. But if you want to invest even in Taiwanese S&P Taiwanese version of S&P 500, it is a perfect way, for you to grow a lot of money over time. Okay. And whenever I show this, all my students in my class just freak out and they go like, so like in like 15 years from now, when I get to your age, I can make like $100,000. And I'm like, as long as you can actually invest like 1/6 of $100,000, yes, you will be. Because statistically, it's bound to happen. Yes, there will be some up and down, and I'm gonna tell you the disadvantage of index fund as well. But if you're investing over 10-year term, then I definitely recommend you to invest in S&P 500 or any kind of index fund, I tell you. So let's actually go back to lesson. Ah, man, I think by the time I'm not sure if we can play the game, but I will introduce the game to you guys. And I think when you guys actually spend time together in person, I think maybe surely you can host a game. There's a single player too, so you can maybe play it once and kind of understand how it works. And then when you play, you can host a multiplayer, and it's gonna be so much fun. I guarantee that. Um. Oh, really? We can prolong. Okay, we long for the game. Okay, we'll try to make it as soon. We'll get there as soon as we can. So again, index fund or ETF. Nice thing is, by buying mutual fund or ETF, you are investing in multiple stocks all at once. So it's almost like one call. That's all, right? As a bundle of stocks, you're not going to lose much money even if one stock crashes. So because you have so much of these companies over here, like just like what you're seeing, even if Tesla kind of fails, like let's say Elon Musk kind of gets sick and Tesla stock falls, but because we have all the other stocks in a bundle, the loss is not gonna it's gonna be balanced out. But the downside is you're not going to make as much profit as investing in a single successful company. But the question is, how well can you spot a single successful company, right? And that is the challenge. So always when it comes to beginning investors, I always recommend that literally investing in index fund is kind of like a investor's cheat, you know. Um, Again, index fund, despite safer than individual stocks, profit is again not guaranteed. But I tell you statistically, if you wait for a 10-year term, is practically guaranteed that you're gonna make money. Now, the fun stuff, right? Individual stocks. By buying a stock, or also known as a share, you can become a part owner of a company. And the idea, right, is buy low, sell high to make a profit. And it's not always the case, but for some stocks, it will give you what we call dividends, which are fraction of company's profit given to the stockholders. Okay. Nice thing about individual stocks, when the company does well, the value of your share goes up a lot, right? A lot. Now you got to remember, you guys got to know how much Nvidia stock actually grew up, right? So Nvidia stock, like exactly 1 year ago, used to be only $48, but now it's $136. So that means there was 182% of, so more than twice, and it's close to about four times of a growth. But not a lot of people can spot that, right? Now the downside though is when your company suffers, so do you, right? And there's no safety net, and there's nothing of a diversifying, make like investing in a lot of different companies. So you wouldn't have that. So if you lose it all. So that's the downside of individual stocks. Let's move on to the next. The other one is actually called government bond. Um, so government bond, I'm not sure how familiar you guys are with this one, but in America, it's quite common for a lot of people to use this. When you buy government bond, you are basically lending money to the government for a fixed period, and the government will give you a receipt called a bond, and and you will earn interest twice a year. And just like a CD, when a bond reaches its maturity date, you will collect the original money. Nice thing about bond is unlike a CD, you can earn interest while your bond is still maturing. So while even before the maturity date, you can actually earn interest. And out of all the investment that I told you, government bond is possibly the safest investment, even safer than savings account, I can tell you. Because what because what is more likely? Which one has a higher chance of failing between bank and a government? We don't want to imagine it, but bank has a higher chance of failure if something happens, right? Exactly, Aaron. A government is too big to fail, right? So that's why bond is considered to be the most safest way of investment. Well, I wouldn't actually say most safest way of investment because we are going to talk about gold because that is the safest. But still, generally speaking, government bond, unless that we unless there's a World War III and there's a nuclear war where entire governments on the earth is all like gone, bond is the safest way to go. Downside, the shortest period of the at least US bond is 52 weeks, which is 13 months. Because remember, for CD, we have like 5 month, 8 month products. But for bonds, they are usually very long. And interest rates are usually low for the period, right? So 4 months, 4%, about 4% for almost every kind of bond. The last time I checked with US bonds. I'm not sure about Taiwan. But so low interest, but low risk, low return is the government bond. Now, we do actually have other investment methods too. So we have crops. So you can actually surprisingly invest in raw materials, energy resources, and natural resources. So crops is just one of them. Now, you see, when you invest in crops, you're not buying the actual wheat, but you're buying the ownership percentage based on the current like harvest, current supply and demand level. Okay. Nice thing about crops, quite interestingly, is commodity price rises with inflation. So when there's an inflation, we think our stock's gonna go down, economy's gonna struggle, right? Because of inflation, the central bank and the bank will increase the interest rate to fix the inflation and all those things. So your stock's gonna go down, but for if you invest it in commodities, because they rise with inflation, I would say the commodity investment is the only way for you to actually make profit from inflation. 呃，英文也 something something 吗？um, I'm not quite sure what that means. But anyway, um, some another pro good thing is more diversification. Now, downside is very of it fluctuates a lot, you know, high volatility. So it's very depending on natural or human disasters, natural resource price actually change quite a lot. But again, um, one takeaway just for the crop is that you can actually make a lot of money when there's inflation, and that would be the only thing that you can actually make money from inflation. Now, gold, the true classic shiny and precious metal, right? When crises hit, investors tend to buy golds a lot. Good thing about gold is it is very stable. So even if economy crashes, right? Even if government disappears, the value of gold will stay pretty much constant all throughout the world because everybody will want gold, right? But so perfect option when there are economic crises. However, the downside of gold, it is also is very stable. So you're not going to actually make an additional income or it will be very hard to like actually have your money grow when you invest in gold. So again, unless economy is crashing and very struggling, like I wouldn't really invest in gold. So this is kind of my personal recommendation methods for like how long of a saving that you want to have. So if you have like a less than 1 year to 1 year kind of investment, suggest that you put your money in the savings account or make yourself certificate of deposit with about 1 year maturity date options. Now, if you're looking to invest for about 1 through 5 years and you can sit back and wait, then I suggest that you buy certificate of deposit with longer maturity options, or try to do individual stocks, and government bonds is also a great way. But if you're looking to invest longer than 5 years, like you're kind of a person like me who just put money and sit back and relax and let the money grow, then index fund is a great way to go. The ETF we talk about is a great way. Or government bond with 5 or longer option is a great way to go as well. Now, last but not least, we're about to play one quick game. We'll try to play as maybe just one round of it. So in this game, it's called Build Your Stacks. And literally the website buildyourstacks.com. That is the website. So this is kind of how it works with, oh my gosh, with Build Your Stacks. So when you open it up, we're not, oh my gosh, we're gonna, hold up. Okay, I hope you guys can see the Chinese characters fine. But when you open this game, you'll have all these options of investment, but you're not gonna see them right away. Like it will appear time after time. So the game works like this: 20 years of investing decisions in 20 minutes. And so, like, every year is just 1 minute long, and we'll play this for 20 years, so 20 minutes. Now, this piggy bank character often drops helpful or sometimes even misleading hints. Okay. And you're going to invest your money with the pocket cash. So this pocket cash replenishes every 30 seconds. So I think you'll make like about $4,000 every 30 seconds. And your choice to invest in wherever you want. Um, we will be competing against each other to go head to head with the computer. Um, and then you will actually unlock new investment opportunities throughout the game. And you can, if you click like what it says as a balance, then you can change the thing into either balance, which means like how much total money you have, or you can turn it into profit too. So how much money you are actually making. You can, by clicking it, it will change it automatically. For individual stocks options, prices will update every 5 seconds, and you gotta watch the trend before trading. And when you're selling or buying stocks, you can choose to buy or sell 1, 10, 25, or max, and then click sell button or buy button. And lastly, if you each new investment opportunity comes with a pithy explainer. So if you want to know more information about it, you can click that question mark. On that one couple things about this game. So this game actually takes actual historical economic trend in random 20 years in American history. So, and also, so it can be from 2004 to 2024. It could be 1960 to 1980. So it just takes a random time period, but the trend and everything is actually based on real American history and how like stocks performed at that time. And you see the individual stocks, they are actual historical companies too. But because because they don't want to like spoil you, it will actually just give you a weird like related name. So like on this screen we see Funtech, Dwan Gaming, Fizzy Drinks Inc, Fuel Core, Saving Lives Core. But at the end of the game you can actually see what these companies actually are. So like Funtech could be Apple, and Dwan Gaming could be Blizzard, fizzy drink could be Coca-Cola. So you will actually see those things as well. I know I explained a lot, but I think if we play this game, you should be able to understand it after one round. Now, Shirley, I have a quick question. What would be actually more beneficial for us? I can actually just try to play the game as a single player and just show how it works, or we can try to play multiplayer. um which way do you think would make more sense for our time?
I think maybe you can choose the first one because we know nothing about this game.
Okay, perfect, then
We
I'll
have
do
not
that.
really played it. Yes, thanks.
Okay, so okay, then I can just play myself and show you how it works. Okay, so Shirley, if you want to play as a group, you can also like just play in group, and on your computer you can create group and have students choose the join group option. So and when they click join group, they can just type the group code and they can join the game, and it will pop up on the screen who joined. So it's going to be very who's easy to track who joined the game and whatnot. Um, but because of our time constraint, I'll just play this alone. But the way it works is going to be the same. Okay. By the way, yes, you can actually see who's winning, who's losing, and everything too. So it's going to be a very interesting game. And actually, Shirley, if you're the host, you can have your screen up on the like a TV or something, and it will show you the entire leaderboard. So it will constantly change the ranking every time. So anyway, without no further ado, let me play this by myself. One thing you gotta know is computer actually has 76% chance of winning all the time. But their strategy is only by investing in index fund. So unless I outperform the market, because index fund represents the entire market growth. So so basically 76% of the time market grows more than like individual investors. But let's see if that will be the case in my situation. So play alone. There's a little bit of a tutorial. I'm just gonna skip it around for now. So savings account. Um, savings account, like here, click got it. And now actually the time already started. So I have to deposit my money right now. So I can just click max to click the number, but I can also like write down the number too. But usually because savings account is the only way for me to make money right now, I'm just gonna do max deposit. So pocket money, um, is gonna see after 30 seconds it replenished. So I'm gonna put in $4,000 again. I'm making a little bit of interest, but not much, right? Not much profit. Now, in when 30 seconds is over, I think there will be a new investment opportunity coming in about 10 seconds. Leaderboard, see computer for some reason always starts with $300 more than me. I don't know why. Now I click unlock here and it's gonna pause and it will explain to me certificate of deposit. and I just click got it. And now I'm going to withdraw maybe entire money. So I click max, withdraw, and I buy, click buy, and I can actually choose the interest rate, right? So 3 months AP 3.11, 1 year for 5, 3 years. Since we got a long time, it's just first year. How about we go with max on this one? So buy everything. But ooh, look. So here it says, congrats on your rich new job. So I have to pay 200. But you see, I'll try to find fund. But if I collect this, because it's CD, I'll have to pay penalty. And oh darn, I actually don't have any money on savings account. But because 30 seconds passed, I made some pocket money. So I'll pay with the pocket money. And I have still $3,000. I'm going to invest all in the certificate of deposit, and I click unlock index fund. Now, so now this is where the computer has been just investing all its money on this. So because I don't have any pocket money, let's see if I can actually win. So I'm gonna play until like 5 or 6 years because after that, all the investment opportunities will be unlocked and you should be able to see it. So I'm gonna now invest in index fund. Hopefully it goes up. Oh no. So here you can actually see profit changing, right? But if I click this button, it actually changes to balance. But because I want to see how much money I made actually, so I'm gonna just click the profit to just see. Now leaderboard. Ooh, I'm winning. All right. So far so good. And now here comes the individual stocks. So now I have to see Funtech, it's Electric Inc., BuyStuff.com, Save Cash. I think BuyStuff.com has to do with like Walmart or something. So, or Funtech. Funtech might be Apple. Who knows, right? I like technology. So I'm going to buy whole stocks in technology. And let's see. Ooh, yes. So index fund, I made a lot of money. Here, I made a lot of money too. Oh, now I got a new pocket money. You know what? While market is down, I'm gonna invest a lot more into the fund tech. So this is kind of one month. Oh no. Find funds. Oh man, I have to pay for this now. I can't take this out because I'll pay penalty for certificate of deposit. I'll just wait out until pocket money actually fills up again. But man, I have to pay $200. Sometimes if you're lucky, you can actually make money from like random events too. Ooh, 3 months for 5% is not bad. I'm gonna go with that. Ooh, nice. Nice. Let it grow, right? Now this money matured. I think I'm going when it goes down more, I think I'm gonna buy like 25 more for the fun tech. I think buy stuff has to do with like Amazon or Walmart. I'm gonna invest some in the buy stuff. 1 year I'm gonna choose 7% for 1 year is not bad. Oh no, buy stuff. Oh no. So now I think in the fifth year, oh god, ding dong, wedding bells are ringing. So yes, yes, deja vu. Yes, I have to save money too, but in real life. But so man, now because I actually have no money, even if I pay with the pocket cash, I don't have it enough. So what I'm gonna do is I'll try to sell maybe 23, 25 stocks. That's not enough. Maybe I'll sell all of the buy stuff stocks. Now I have enough. So I'm gonna click pay in cash. I want certain money to be made. So I'm gonna go with the certificate of deposit. My index fund is growing just fine. Ooh, it's good that I didn't sell all of the fund tech, right? Because it's been it's been growing, it's growing, it's growing. But look, compared to compared to even though I thought I was doing well, computer who's just betting on the market is winning me, right? So I'm gonna buy everything on Funtech. Let's see. Hopefully it goes up. All right. So 1 year 7.8. That's not bad of an interest rate. Wow, it's climbing up. Nice. I think. Oh, question. Why you need to pay 200? Is it for, oh, that's a very good question. So this can happen to one student. It may not happen to other student. It's just like penalty money, like for some life event. So it just happens by random chance. That's a very good question. So just like this, right? You got dropped. Um, I can pay with the pocket cash. If you read the explanation, you will know almost right away. Um, hmm. Now, I think like the new investment opportunity, incoming investment. Now I think everything will be unlocked. So I have the government bonds, and oh, I think it's not unlocking until like year 8, I guess. We can I can't wait until oh my gosh, until everything gets unlocked, and then I think we'll have to wrap up after that. Ooh, let's see. I have $10,000. It's a lot of pocket cash. I know, Piggy. Now, gonna buy, and let's see. Hey, I actually caught up a lot. I, I'm winning. I'm winning. I'm winning. I'm winning computer. Yes, yes. I'm smarter than computer. Yep. That's right. That's right. Oh, when it's a green window, it actually means I made money. So I'm gonna receive. Nice. Now, I want to buy some government bonds with a certain return. So, 15, maybe how about $10,000? So I'm gonna do that. Ooh, one year for 8% interest rate. That's a good money. That's a good money. Oh my God, computer already surpassed me right away. Gosh. Okay. Oh, now is the time when it goes down, right? Yes. See, it's it's just gambling in a way with the stocks, but this is why like you shouldn't always just gamble in one thing, right? Crop commodity. If you withdraw money early, uh, if have to pay penalty. That's a very good question. That's only for the certificate of deposit. If you withdraw money early from certificate of deposit, yes. Those pop-ups with the $200, they are random events. So some kids may get that pop-up, some kids may not get that. Some kids actually may get like surprise $5,000 money. They will receive money. Some people not receive that money. So it's just like individuals. It's just happening by random chance. And then we have crop commodity, and I think it because this is actually happening as a single play. I think all the investment opportunities are getting unlocked a little more slowly. But if you play as a multiplayer, I think by year 5, everything will be unlocked, if I remember correctly. Because I remember when government bond gets unlocked, it unlocks also like crop commodity and also gold as well. So I think it's just because it's a single player. Maybe it will be a great way for you to first learn the game by playing single play, but you never know. Well, I think that should be enough of an information about the game. I think the rest is as you play on your own, you'll understand it much better. And I actually kind of like to end it here because I'm winning a lot, so I'm just gonna get out of there. Um, so I hope that demonstration of the game made sense for you. I hope once you get a hang of it, there's a lot to learn. But if you understand like one thing, like I know everybody will lock in and just play this all the time. Um, let's see. Oh,
Thank
one
you,
last
Vincent.
thing. Oh, yeah. That should be it. If you guys have any questions, just let me know through Shirley, and I'll be glad to help you with that.